anything else, ranging from building sustainable agroforestry supply chains in the Amazon to rapidly expanding the portfolio of sustainable urban infrastructure in Africa. Worth noting at this time that these instruments combined together offer up nearly $350 million in climate investment opportunities for impact investors, both commercial and catalytic.
Well, yeah, that's well noted, Vikram. I think in light of the recent numbers we just got this week from CPI's Global Landscape of Climate Finance, and as you can now see on the screen, global climate finance flows reached $632 billion on average in 2019 and 2020, but with a tepid growth rate. In this diagram, you can see that public and private actors have steadily been increasing their climate investments in the last decade, but the flows largely plateaued in the last 4 years. And this is worrying because COVID-19's impact on climate finance is still to be observed in the coming couple of years. And also the flows increased by only 10% compared to 2017 and 2018. And this is much slower than in the previous periods. And annual climate finance flows in the previous years, for example, increased by about 24 or 25%.
And of course, on top of this challenge that you've just laid out, there's still a significant gap between the current flows as presented and what's needed for a successful low carbon transition. As shown in this slide, there is a huge gap between the current annual average flows of the required investment as identified by various reputable agencies and studies from IEA, from IRENA, from the Bloomberg New Energy Finance and the Global Commission on Adaptation. And so while there is no definitive estimate of the investment required to achieve the global climate goals, it's clear that incremental increases in climate finance are not going to be sufficient. Finance flows need to increase decisively and substantially. And of course, they need to start being counted in trillions and not billions anymore.
Yeah, and that certainly amounts beyond what is available with governments and philanthropy, but money is available in private capital markets, and we all know that. And this is one of the reasons why CPI launched the lab back in 2014 to address this crucial gap in how the world tackles climate change, the flow of private capital towards climate-friendly investments in developing countries. The aim of the lab is to play a key role in the transition to a zero-carbon, climate-resilient economy by identifying, developing, and launching sustainable finance solutions that have the potential to drive billions of dollars in private sector climate investment in developing countries.
And so the lab was launched to identify and develop innovative ideas that use small amounts of grants and concessional capital to grow into self-sustaining investments that create significant impact at scale. And it is working. The group represents, this group that we are about to showcase here represents the 7th annual lab cohort. And the previous combined 6 cycles developed 49 ideas that collectively have gone on to mobilize more than $2.5 billion in climate action in multiple regions and sectors. Just a smattering example of public and private investors that have supported lab instruments to date include Citibank, the European Investment Bank, the Dutch bilateral lender FMO, the Green Climate Fund, the Inter-American Development Bank, and the World Bank. But why does it work?
Well, Vikram, it works because the lab is unique in bringing a diverse group of stakeholders to the table to help develop these ideas. The lab has grown to a member-supported organization of more than 70 governments, development banks, philanthropic organizations, and private sector experts who actively contribute to the development of each year's selected ideas. And our members, along with teams of lab and analysts and the proponents for each idea, collaborate on a year-long process to develop truly novel ideas that address existing barriers to investment in sustainable development. But the lab's process goes beyond idea development, as reflected in today's demo day. The lab and our network enable financiers and policymakers to move these ideas into action. And just before we dive into the 6 ideas we have to present to you today and about which we're super excited, let's hear from the lab network. And I am very pleased to have here with us 2 great partners in steering the direction of the lab, informing which submissions are most promising, shaping the design of the instruments and vetting them to overcome financing barriers, but also helping to pilot them. So I'm first very happy to welcome Lina Klosner, who is the Deputy Managing Director at the Nordic Development Fund, where she is also leading the fund's business development and outreach activities. Lina has been playing a key role in designing NDF's climate change and development strategy and operations, and has helped to develop innovative climate finance mechanisms, both for public and private sectors, to both mitigate and adapt to climate change. And NDF is one of our top investors in terms of number of lab instruments invested in. So building on her large expertise here, Lina will be talking today about the need for financial innovation to tackle the climate crisis. Welcome, Lina, and the floor is yours.
Thank you so much, Barbara. Thank you. Really wonderful to be here today. And thanks so much for inviting me to join this group of fantastic colleagues. But first of all, let me congratulate your entire team for the excellent work that you have and the achievements you have achieved in the context of the lab. And most recently, your great work has been recognized by the UN Global Climate Action Award. That's really fantastic news. So congratulations on this very important recognition. We know that the selection criteria for winning the prize, they are very strict and they focus on really action and results. And the winners include really some of the most innovative, scalable, replicable examples of action to tackle climate change globally. And these projects are typically very much recognized also as solutions that don't only address the climate change, but also help drive towards progress on many of the sustainable development goals, innovation in general, gender equality, and different kinds of economic opportunities. So, for us as an institution focusing on climate and development exclusively, this is very much in line with our thinking as well. And these have now demonstrably been also the core actions at your side. So we are very, very fortunate to have this partnership with you. And for NDF as a financier with this exclusive mandate on climate and development, the lab has really been an excellent platform for us for the identification of potential innovative investment opportunities in a way that really leverages the skills of the different partners participating in this network in an optimal way. There's really no way we could have approached and achieved this alone. And particularly, I would say beneficial, what we have in the NDF toolbox is the opportunity of the NDF financing to carry risk, the opportunity to de-risk different initiatives, to participate in the upstream activities, the spots where very few financiers actually have the capability of being, and also the ability of NDF to combine different instruments for different purposes to get the different innovative financing mechanisms designed and then to take them off the ground. And throughout the years, the lab has really been for us an important source of investment leads. And we have picked up investments that have been endorsed through the different lab cycles. Some of these initiatives have been really, really, successful in a global scale, so that they have, with very initial contributions from NDF and from some others, they have now grown, and that is exactly the kind of leverage and development trajectory that we would like to see with these initiatives. Some examples that we have picked up from the lab endorsement cycle, they include the very innovative first of a kind investment craft fund, which is run by the Lightsmith. There we had a very small initial contribution to contribute towards the design of the fund, and then consequently we'll also hand a closing of fund. We have also contributed to the Climate Investor 1, which is today already a Climate Investor 2. Similarly, same kind of structure there. We provided first upfront structure grant and then a subsequent investment to the junior tranches of that investment fund. One more example is the Cloud Forest Blue Energy Mechanism, where we have a smaller grant towards the initial phases and the sort of testing the concept and structuring this pay for success mechanism, which is targeting sustainable hydropower production through conservation and restoration of the some of the catchment areas. So I mean, I couldn't really highlight more the high relevance of the lab itself as an instrument, because it is a prime example of an initiative where large numbers of highly professional institutions, they come together and collectively use a massive amount of knowledge around different initiatives that have a wide applicability and global, which is, you know, it is, and that ensures a high quality of the analysis. And that again is a much needed and necessary basis for investors to consider these initiatives for further financing. So you have in a way prepared a lot ready for the investors to come on board. So we really look forward to learning more about the new batch of projects and to further develop our collaboration with the lab for finding solutions for the causes and consequences of climate change. With these brief remarks, I wish you all a very, very fruitful event and engaging discussions. And thanks again for giving this opportunity to give these greetings from the Nordic Development Fund. Thank you.
Thank you so much, Lena. And again, thank you so much to you and the whole team at the Nordic Development Fund for your partnership and for really helping to bring the lab instruments to light and to really practical action on the ground. Much appreciated. But with that, let's now hear from Joan Larea, who is the CEO of Convergence. Very clearly, you all know about Convergence, but it's a global network for blended finance. And Joan and her team has been another close partner in the lab. Joan is an expert in catalyzing investment in places that need it most, with over 25 years of experience in emerging markets investing. And since 2016, Joan's leadership has really driven Convergence to become a global independent authority for blended finance. As CEO, she ensures that Convergence continues to grow the field of blended finance through its products and its services and accelerate the flow of private capital into SDG projects across Africa, Asia, and Latin America, and again has also helped some of our lab instruments see the light. And so with that, welcome, Joan, and thanks so much for joining us today to offer your input on the importance of blended finance for the climate agenda. So over to you.
Thank you, Barbara. And listening to my own bio, I realize that it talks about building the field. And you too are a field builder at CPI, and so we recognize the value of what you do. It's incredibly important. And on that note, I'd like to join Lena in congratulating you. The figures on what you've actually achieved are great. Everything needs to be at a much, much bigger scale, but you are doing incredibly valuable, important work and focusing on scale. So yes, blended finance is pretty key for the climate agenda, particularly in the newer areas and the less easily measured areas like adaptation. Interesting factoid, by the way, there's also a gender element when you get into adaptation. We went through and looked at our stock of known closed climate blended finance transactions and noticed that over half of the adaptation transactions are gender aware by our standards, as opposed to 7% of all transactions we've been able to record that have happened out there. So just interesting factoid for you. But look, not only is blended finance really critical for the climate space, but conversely, climate is a really, really big deal in the blended finance world. Again, if you look at the almost 700 transactions we've captured data on, over 100 of them have been somehow connected to climate. So there is a tremendous appetite for investment in this space. There's a tremendous appetite among donors to do something. So we have some work to do and hopefully some commitments to getting it done. But as you just said, and in Vikram, that slide showed is stark, that climate finance is not growing fast enough, nor is it already on a level that it needs to be. The world of blended finance also, I would say, shares that pattern. In fact, it took a hit in 2020. I'm talking about blended finance for all sectors and all SDGs combined. We're about to release our 2021 State of Blended Finance report next Wednesday, October 27th. You can sign up for the launch event on our website if you're interested. And you're going to see that blended finance dropped significantly. So not only is climate finance not large enough, but blended finance is having trouble delivering what we need it to do. So we all need to really double down on the efforts. Another observation from our own work is that early non-return seeking support for transactions is really, really key. We went back and looked at all the adaptation transactions we know about, and 1 out of 5 of them used what we call design funding, really early stage support in the grant mode before any commercial investor is even looking at the transaction. And this is much more of a pattern than it is in the mitigation space. So early stage support is critical. The kind of granting we do at Convergence, where we do design stage funding, is important, but also the kind of support that a CPI lab can provide is incredibly important. So the work that you're doing, the kind of partnership we have, I think is going to be pretty critical. CPI and Convergence have collaborated really informally ever since Convergence got started up, and we are delighted to have done that. We have, in fact, funded a number of the ideas that have come out of the lab process. We're looking for ways to systematize that collaboration, and try to deal with the fragmentation of the support system that exists at the early stages of new transactions. So hopefully we in CPI can figure out how to do that. I just want to turn to the list of instruments that are the subject of today's discussions. I was really interested to go through them and look at the kinds of financing they're looking for. And I see that they are proposing to use pretty much all forms of blending, all the archetypes that are familiar to us at Convergence, design funding, technical assistance, grants and other patient capital inserted into the capital structure, guarantees. So all of the things that, all of the tools available in the blended finance world are being showcased today. I also noticed that these are ideas that are attempting to hit scale, which is wonderful to see. It's absolutely a desperate situation that we need to deal with this emergency we find ourselves in, and we have to operate at scale. So even the smallest ones that I looked at, the Peace Fund actually provides a revenue line into larger transactions. The Guarantee Fund, obviously by doing guarantees, it supports much larger scale investments by other parties. So glad to see that. And I really encourage everybody dialed in today to please engage, listen to the descriptions of each of these, engage, ask questions, and follow up as appropriate. So thank you very much for giving me the space to speak, and congratulations again, Barbara and team.
Thank you so much, Joan, and thanks so much for all your work, and again, this fantastic collaboration that we've had, and again, very much look forward to thinking about how we can formalize and make our partnerships more systematic, because again, I think we all see this fragmentation, we all see this fantastic pool of innovative financial solutions, but we now really got to think about ways of becoming more strategic and targeted in terms of joining forces. But with that, it's now time to hear directly from the lab entrepreneurs of 2021. Again, we had 6 instruments today. As you know, they represent the latest innovative approaches in sustainable investment. It's a truly diverse class in terms of sectors, geographies, and financial innovations, as you will see.
Together, these 6 instruments seek about $20 million in grants and present investment opportunities of almost $350 million in all forms of blending that Joan highlighted. That's about 17 times more in commercial and concessional capital for each dollar in grant. So good value for those grant makers interested and on the call today. This would ultimately contribute to many key sustainable development goals and represents significant effort to many, significant support to many developing economies in meeting their own climate goals, particularly many in Africa, as will be highlighted in due course.
Yeah, and if each of these successfully pilots their instruments, it would mean the sequestration of close to 2 billion metric tons of CO2 equivalent during the lifetime of the pilots, not to mention 3 million hectares of standing forests, which is almost the size of Belgium, and 1 million households achieving energy access. But with that, let's move to the first instrument of the day, the Smallholder Resilience Fund from our Sustainable Food System stream. And I'm very pleased to welcome now Andrew Yoon, the CEO of One Acre Fund, who will walk you through their solution for building climate resilience for African farmers through improving agricultural value chains. With that, over to you, Andrew.
Hi, I'm Andrew, co-founder and CEO of One Acre Fund. We work directly with over 1,400,000 smallholder farmers to provide inputs on credit and training. So first, let me tell you why we do this work. This is Marie Usabayumva, a farmer and One Acre Fund client in Eastern Rwanda. She has 3 children, and farming is her main source of income. We often ask our clients for feedback. When she was asked how we can further help her family, she requested that we help find markets so she can sell her harvests at higher prices. The market challenges farmers like Marie face are caused by issues throughout the value chain. The challenges start with farmers. They can't physically get to selling points, limiting the amount of supply that businesses in the value chain can access. In addition, many value chain businesses themselves are small, not investment ready, and therefore cannot access commercial finance. And some essential businesses simply do not exist at all. As a result, the system does not work for smallholder farmers. Furthermore, climate change is creating even more risk for farmers. Rainfall is less predictable, temperatures are rising, and soils are being depleted. This is why we'd like to launch the Smallholder Resilience Fund, to get the incentives right for both farmers and businesses at the same time. We will take a synchronized approach to address market failures simultaneously. First, we will work with One Acre Fund's existing 1.4 million clients to grow climate-friendly crops and aggregate the harvests. This network is over 50% women. Most of our 8,000 full-time staff are based in the field and interact with farmers every day, providing loans, training, and input delivery. We'll continue to expand this work, particularly in harvest aggregation, to help farmers access premium markets. Second, we will deploy capital and technical assistance across the value chain. This ensures every link can do its part, and we can support investment-ready businesses to attract private capital. And third, when we don't see a business, we can simply build one with a venture studio. It's really important to solve all of these problems together. Value chain businesses need to have significant aggregated farmer supply to buy. Farmers need to have high quality businesses to sell to. You cannot just solve one side of the problem. And that's where our assets with both farmers and businesses are helpful. In terms of climate impact, the Smallholder Resilience Fund will support farmers to grow climate resilient and climate friendly crops with a big focus on tree crops. These crops have more stable yields than grains and are higher value. Further, millions of new trees will be planted as a result of the Smallholder Resilience Fund to sequester carbon and improve soil health. Combined with our agroforestry work, we will continue to improve biodiversity and prevent deforestation. We work with farmers to select crops that are environmentally well suited to grow in the areas we work. For example, in Rwanda, the climate is well suited for avocado. The trees are rain-fed and planted alongside other crops and trees, not in plantations. Let's look at the avocado value chain in Rwanda as an example, since we intend to do a pilot there. In the field, we can offer tree seedlings, extension services, and offtake. We can help organize farmers into groups who can sell high-quality production with aggregation into market points. Across the value chain, we can make investments in input providers, exporters, and avocado oil producers. Fresh fruit is the highest value, but oil is key because not all fruit is fresh grade. We can also build cold chain to address lack of capacity and provide sustainability certifications for farmers. As a result of these multi-pronged investments, we can ensure the whole value chain is strengthened and small-scale avocado farmers are able to engage with it profitably. One Acre Fund is well positioned to lead this effort. We have a network of 1.4 million farmers in 9 countries, strong relationships in those countries, and a history of innovating and managing large amounts of capital. We'll launch our pilot in Rwanda, where we have a deep presence, serving 700,000 farmers directly. We also partner with the government and local companies to reach another 1 million farmers through partnerships there. We have ambitious plans, apologies, next slide. We have ambitious plans to mobilize commercial and concessional capital to serve smallholder farmers. The pilot in the avocado value chain in Rwanda will initially be grant funded, so we can test different forms of capital like equity and debt and learn quickly. We've engaged legal counsel and begun the initial due diligence and are ready to launch. Once we prove the synchronous investment concept, we will expand to other value chains and raise more concessional capital and increasingly commercial capital. In 7 to 10 years, we expect to mobilize 100 million of capital, reach 1 million farm families, and plant millions of trees to sequester carbon. We have a network on the ground ready to move, an investment-ready pilot, and a bold vision for the next 10 years. Thank you, everyone, and thanks to the lab for their continued support. Our team has learned a lot throughout the process, and now my colleagues Eric and Melindy will be leading Q&A, and I will support.
Wonderful. Thank you so much. Very much appreciate the fantastic overview of the instrument here, and also really very much for want to thank you for all what we've learned actually also from you. I think it's been a really good journey, and I think it's also a really important one, particularly this year as we see all the increased focus on food security and how can we better work on this nexus between climate action and food security. So that's been fantastic. But so as we are waiting for questions from our audience, and again, please use the Q&A tool that you have available to kind of put up your questions. I'd just like to get started with one initial question from my side here, and just to understand really, how do you guarantee the increased farmer income from the mechanism? And maybe as again we're waiting for additional questions, would be just great to get some real world example from your side.
Sure. Thanks, Barbara. That's a great question and a really important one. So let's take the example of the avocado value chain in Rwanda that Andrew mentioned. To answer how we anticipate we can guarantee increased farmer incomes. So currently, most farmers can't. The current situation, most farmers can't find a buyer, or they're selling at a low price in their local market. And so, if those value chain gaps are addressed, we see that farmers could take advantage of 3 higher price and higher volume opportunities. The first being in avocado oil. So farmers already cultivate a local variety of avocado that's ideal for oil, but oil processing capacity is very limited. So with financing from SRF, SMEs would invest in higher scale oil processing machinery, thus increasing demand for the local variety avocados. Second, we see opportunities in export markets that farmers can't currently access because of logistics gaps. So the venture studio could set up a cold chain company to help address those and help farmers get a premium market price. And third, we're seeing growing demand amongst consumers who want to know where their food's coming from. So with One Acre Fund as an aggregator, food brands would have an opportunity to pay a premium price to farmers for avocados with traceability all the way back to a specific farmer, like Marie Usabyumva, instead of just buying a commodity avocado. So that's a quick answer as to some real world examples on how we'd assure improved farmer income through SRF. Thanks, Barbara.
Fantastic. Thanks so much, Andrew. We have now actually 3 questions. We don't have that much time, but I'd love to see whether someone from your team would like maybe to come up and really kind of make sure that we're kind of addressing some of the questions. We obviously will also capture all the questions and get back to all of them later in the course of today, but also afterwards. So maybe there is some questions around how you reach out to other farmers, but I think also kind of related a little bit to how you measure the impact of farmers. So maybe if you can just get the answer from your team on that one.
Yeah, Melindy, do you want to take the how we measure farmer impact question?
Sure. Thanks, Barbara, for the question. I think that's an important question. And impact measurement is, of course, very critical in this type of work. So we already have a well-established measurement and evaluation infrastructure. And in Rwanda, for example, we visit around 2,000 farmers physically in their farms every year. And we measure the harvest of the farmers in our program and compare this to harvest from farmers who are not part of our programs. So we also do this for trees, where we track the growth of trees and we look at survival and we look at how the trees are developing. And of course, over time, we also do resurveys to measure the integrity or to figure out the integrity of our measurement strategy. So overall, impact measurement is critical to the work that we're doing, and this is how we're doing this. And we're also trying to look at how we can incorporate some of these metrics into climate indicators such as carbon dioxide sequestration, because we're working a lot with trees and fruit trees in particular. I hope that answers the question.
That's very helpful. And again, I do apologize to the audience as we have to move on to our next instrument. But again, the team will stay here. We will reply to all the questions either today directly here or after the webinar. But thank you so much again to the whole team for all the fantastic work. And with that, let me hand over to Vikram.
Thank you, Barbara. What a great start. The next instrument is from our Brazil program. The Amazonia Sustainable Supply Chains Mechanism, topical as well, given the discussion of supply chains in every form of media. Carolina da Costa from Mauá Capital is here with us to offer her solution to enhance forest-compatible value chains in the Amazon. Carolina, the floor is yours.
Thank you, Vikram. Good morning. I'm here with my colleague, Caio Sarham. We are all of NATURA, representing the world's largest B Corp and the fourth largest pure-play beauty company. We, from Mauá Capital, a 16-year asset management firm with a strong expertise in structured credit and committed to sustainable investing, partner up with NATURA to develop the Amazonia Sustainable Supply Chains Mechanism, an instrument that leverages offtake agreements for forest-compatible products to provide upfront finance, technical assistance, and a structural community resource that, oops, I think my camera is off. I thought they would release. Okay, hi again. So an instrument that leverages offtake agreements for forest-compatible products to provide upfront finance, technical assistance, and a structural community resources that catalyze the bioeconomy to keep forests standing. Moving to the problem. The Amazon region contains 67% of the world's tropical forest cover. Despite a growing global demand for forest-compatible and bioeconomy products from the Brazilian Amazon, the region contributes not even 0.2% of the $175 billion forest-compatible and bioeconomy global market. Some reason for that are weak supply chains, lack of productive capacity, infrastructure, and finance. For example, livestock got over 80% of the available credit in the region last year's harvest season. Structured with NATURA as a major off-taker and with a strong expertise in the region, AMS-SC will provide adequate finance, technical assistance, and investment in enabling conditions to build forest-compatible value chains in the Amazon. While there are other funds investing in sustainable value chains in the Amazon, AMS-SC is unique in having the participation of a fund manager and a strong off-taker in the structuring of the fund. The instrument mechanics has two components: a receivables fund that pays suppliers upfront in exchange for receivables, and the off-taker then repays the fund for the off-take purchased. An enabling conditions facility that will work alongside the fund to improve cooperatives' capabilities to deliver quality products and ramp up their productive capacity. In addition, the ECF will provide a broader set of investments to communities, including financial assistance, education, healthcare, access to internet, and infrastructure to contribute to their sustainable development. Eventually, in later years, ECF might get returns from the receivable fund as means to phase out from donations. Talking about impact, AMS-SC is aligned and contributes to achieving several sustainable development goals. It aims to preserve 3 million hectares of forest in the Amazon by 2030 through the purchase of 89 bioingredients, preserving the integrity of native vegetation, and implementing agroforest systems in the aggregated areas would avoid a potential 1.4 billion tons of carbon dioxide emissions. And the pilot project estimates to reach 40 cooperatives and 10,000 families. The pathway to implementation is composed, so next slide, thank you. The pathway to implementation is composed of 3 main phases with various milestones along these phases. Upon NATURA's board approval, fundraising for the funds and engagement of local cooperatives to co-construct value proposition starts in 2022, with the receivables fund expected to reach up $15 million by year 3, coupled with detailed monitoring and evaluation strategy for the goals of the fund. From year 5 on, receivables fund is expected to grow up to $50 million, also considering at least 2 more off-takers in the arrangement. It is also part of the plan to identify pathways for ECF to phase out from donations. For the initial 3 years, the receivable fund will raise $15 million in 3 tranches, 20% subordinated, 10% mezzanine, 70% senior. The mezzanine tranche, working as concessional capital by having its principal preserved, will help to reduce the cost of the structure. Non-refundable grants will be directed to the enabling condition facility. AMS-SE brings a new model of corporate responsibility as promotes sustainability in supply chains and contribute to the betterment of suppliers' communities. It offers a systemic approach to change and an opportunity for companies to take the role of traditionally held by financial institutions, but in a way that brings more value added to the suppliers and maximizes the potential of the entire ecosystem. Thank you very much, and a special thank to the CPI team for the great mentorship during the process. Now we are available for taking questions, Kyle, Sarhan, and I.
Thank you so much, Carolina. Let me, while we wait for some Q&A, if at all we have time for another one, let me sort of focus on NATURA for a minute. Besides the off-taking agreements and the financial resources that you highlighted, what other expertise does NATURA bring to support this mechanism?
Yeah, I think I can take that. Thanks, Vikram, for the question. Hello, everyone. Well, I think NATURA adds a lot of, NATURA adds a history, indeed, because NATURA has been working in the Amazon region for the past 20 years, right? NATURA has already developed supply chains. NATURA has an internal supply area which manages the relationships with the communities, right? And knows on the ground how they work and what they need. And also we have a network of service providers that are going to be very important for this project in terms of the technical assistance needed and the investments and mapping the investments that are actually needed in the territories and the regions that we operate. We have specific brands that are related to the Amazon. For instance, Ecos, which eventually some people here know the brand. It's very known from NATURA. And we have a business plan that intends to increase the volume of bio-ingredients related to some specific brands that we bring to the market. So NATURA is very committed to the region, very committed. The business is very related to the region, right? We need inputs from the region. In addition, NATURA is taking a role of advocacy here in the Brazilian corporate, scene, where we are work together with other companies working to gather efforts to try to solve these major issues that we are seeing in the Amazon region. So I don't know if I answer your question.
No, that was useful. That was useful enhancement. Thank you so much, Caio and Carolina. And now back to Barbara for introducing the next instrument. Thank you.
Thank you so much. And yes, and Next instrument is the PREC Aggregation Fund from the Lab Southern Africa program. So I welcome Sherwin Das, who is the Managing Director at Energy Peace Partners. So we're very ready to hear about your energy access solution for fragile states. So Sherwin, the floor is yours.
Thanks, Barbara. Thanks, Vikram. My name is Sherwin Das of Energy Peace Partners, and I am joined today by my colleague, Katie Retz. And we're delighted to present the PREC Aggregation Fund. This is an instrument that helps extend the renewable energy revolution to fragile states. We're grateful to the lab for helping us to develop and launch the fund. At Energy Peace Partners, our mission is to leverage climate and finance solutions to promote peace in the world's most fragile regions. Our team brings together experts in three distinct areas: peace building, renewable energy, and climate security. The challenge we've identified is that only limited renewable energy investment is reaching fragile states. We heard earlier from Barbara and Vikram and Joan that climate finance levels are not where they need to be. This acutely affects fragile states. We observed that the least electrified countries in the world are also among the most vulnerable to conflict and climate change. On the map, these countries are marked in orange. Yet less than 5% of global renewable energy investment is reaching these states, which are home to nearly 1 billion people. Now, most of these countries are in sub-Saharan Africa, where 75% of the world's population still lacks access to electricity. Communities in fragile states suffer from persistent energy poverty alongside risks related to conflict and climate change. And in these settings, uncertain political and economic environments are deterring renewable energy investors and limiting access to affordable capital. Our solution is based on an innovation we developed known as Peace Renewable Energy Credits, or PRECs. What are they? PRECs are high impact energy attribute certificates. They create value for the social and environmental benefits of renewable energy. For developers in fragile states, PREC sales offer a new way to monetize renewable energy from qualifying projects beyond the sale of power. PREC purchases help multinational corporations support projects that meet corporate, environmental, and social goals. The PREC Aggregation Fund is our solution that leverages the full potential of PRECs. The fund will enter into 10-year forward purchase PREC commitments with developers. Upon commercial operation, the fund will pay developers for their future PRECs. As power is generated, PRECs from a portfolio of projects will be aggregated into the fund, and the fund will resell the PRECs into voluntary renewable energy markets. The fund's value proposition is that it monetizes future PRECs to provide capital upfront when developers need it most and in hard currency. These 2 points are worth emphasizing. Capital upfront is when developers really require it, and hard currency mitigates local currency volatility. This supports the finance and construction of projects that provide new electrification and energy transitions in some of the hardest to reach communities. Developers can leverage PREC sales agreements to unlock additional capital and use PREC sales revenue as sponsor equity or to pay down debt. The fund is focused on 11 fragile energy poor countries in sub-Saharan Africa, starting initially with the DRC, South Sudan, Chad, Somalia, and Uganda. The fund will unlock $90 million for new renewable energy projects while improving the overall investment environment in some of the most challenging markets. At the community level, the fund advances numerous sustainable development goals, including the SDGs on energy access, climate action, and peace. We project that the fund will result in at least 57 megawatts of renewable energy capacity, new renewable energy capacity, almost 10,000 jobs, 325,000 household electricity connections, including, I might add, many first-time connections, and more than 650,000 metric tons of avoided emissions. We are on our way in bringing the fund to market. In 2020, the first PREC sales agreements were executed with Microsoft and Google from projects in the DRC. This year, we opened a Nairobi office to expand our project pipeline. We issued the first PRECs and we launched the fund. Key milestones going forward include the designation of a fund manager, establishment of the fund entity, capital sourcing, of course, and fund execution of PREC purchase and sales agreements. Upfront payments will be provided to developers from 2023, and PRECs will be issued into the fund beginning in 2024. We are seeking a total of $10.75 million. This includes $500,000 in immediate seed grant funding that will allow us to cover fund preparation and setup costs. The fund itself will require $10.25 million, 50% in first loss grants and 50% in concessional capital. Concessional investors will receive an 11% annualized return. The PREC Aggregation Fund is an impact-focused fund that supports transformative renewable energy development in fragile countries in sub-Saharan Africa. What's exciting is that the fund builds on increasing market demand for and supply of PRECs. In the future, the fund can expand to include commercial capital, and it can be combined with larger lending facilities to unlock even more renewable energy potential. We invite you to join us to operationalize the PREC Aggregation Fund and to help extend the promise of the renewable energy revolution to some of the hardest to reach communities. Thank you. And Katie and I would be happy to answer any questions.
Thank you so much, Shervin, and great to have also Katie here. And again, thanks for this fantastic overview. We are a little running short of time, but I want to ask you one question. I want to encourage everyone to continue. Please put your questions in our Q&A box. As you can see, our entrepreneurs are replying to all the questions, and we'll get back to you. But I think just that one question I wanted to ask you and Katie is, obviously, I think we all think about risks in fragile states. So I just like to understand a little bit better, how you have been handling these risks that are associated with supporting projects in these fragile states and how you plan to mitigate them to really make sure that you have an impact on the ground.
Thanks, Barbara. Those are questions we get quite a bit. The risks we've identified include performance risks and financial risks as well. So in terms of performance and security risks, we will be conducting robust technical and financial due diligence on our developer partners as well as on projects. So what that means is that it requires that we ensure that our developers have adequate capacity, technical and financial, and that we work with developers who really understand the local environments as well as the regulatory environments in these communities. We want to also make sure that these projects have a strong amount of community support and buy-in. The projects that will be in the fund will represent a diversified portfolio of projects across developers and across countries. So that spreads the risk. In terms of financial risk, we would make payments to developers only upon commercial operation date. So that means the developers can still use the commercial agreements beforehand to unlock financing, but funds would only flow once the systems are built. And the key piece of this really is that the 50% grant portion of the fund provides that first loss tranche that absorbs some of these risks that I've described.
Fantastic. That's really helpful. Thanks so much again to you, Shervin and Katie, for the great collaboration. Again, we'll look forward to additional questions from our audience. But with that, I am actually handing over to Vikram for our next instrument. And thanks so much. And keep the questions coming to the team. Vikram.
That's great. Absolutely. So far, so good. Now for the third instrument in Africa and still talking about energy access. Let's hear from Nithya on how they plan to use artificial intelligence to improve investments in that sector by addressing the data gap on customer repayment risk. Many of us have struggled with that. And so now over to Kate Steele, co-founder and COO at Nithya, to tell us how the data-driven energy access for Africa instrument works. Take it away, Kate.
Terrific. Thanks so much, Vikram, and thanks to everyone for participating. we can go to the next slide. So at Nithya, we've assembled what we think is a really fantastic all-star team across the US, Europe, and Africa to address the issue of energy access. Next slide. What we're looking at is really one of the biggest challenges that we face in terms of climate and sustainable development, and that's the 600 million people in Africa who lack access to electricity. We see in the market there's products that already exist that can meet basic energy needs, and by our estimate, up to half of the people who are currently off-grid could access a finance solution that's affordable to them. So this market should be scaling on its own, and it's not scaling to the level that it needs to. What we really honed in on was this comes down to an inability to understand consumer credit risk and household ability to pay. If you look from the view of the operators, the distributors who are selling these energy access technologies, if they don't understand the consumer credit risk, it's hard for them to understand their customers, but it's also hard for them to understand their cash flows. Without them being able to fully grasp that themselves, it's really impossible to convince investors to come in a large scale. So we didn't see a scalable financing infrastructure, and we saw serious implications from that. There are households, smallholder farmers, entrepreneurs, all of them left vulnerable to climate change without energy access and productive use technologies, as well as the goal of universal access by 2030, we're not being on target to meet that. And so in the next slide, I'll show what we mean by that not scaling energy financing. If we look over the last 5 years, we've seen a real stagnation in the investment in the off-grid energy space, that everything has leveled off around $300 million per year, and this is highly concentrated on only a few companies. This is what we see without being able to unlock this through data, and we believe Nithya is what is really needed to scale the sector. Next slide. So Nithya is an AI-driven platform for clean energy investment. We've developed models where we can standardize credit risk assessment. And we believe that will catalyze billions of dollars in capital that's needed partly to address the climate change impacts and create that resilience, as well as to achieve universal access. Next slide. So what does that mean? So we've developed our risk analytics engine. This is our data analytics that we use on loan portfolios to forecast customer repayment risk, and really to better calculate what the financing should look like for those different types of customers. So on the right, you see the different types of repayers. We have there's a large portion of the market that will repay quickly and is fully commercial. At the bottom, you see a lot of people, this would be the last mile, and the households that have really limited ability to pay. We think all of these customers can be served, but you need to find the right blend of capital to reach all of them. And that's why Nithya pulls together a blended finance facility that actually is able to address the entire market. Next slide. In terms of where we are now, where we're going, as of now, we've raised $23 million for Nithya FI, our financial intermediary. We're lending in 3 markets and have deployed 4 loans to date, with more in our pipeline. We're offering receivables and inventory-backed financing for solar home systems primarily, but also productive use appliances like solar water pumping, as well as working with microfinance organizations to lend, who are lending in the solar energy space as well. In terms of our near-term goals, by 2025, we expect to have deployed over 100 million in capital, reaching 3.5 million people with electricity, with 700,000 new energy access systems. We see significant impacts in terms of reduction of carbon emissions and replacement of diesel generators, as well as on the economic side in terms of jobs created and income produced. Next slide. Our go-to-market path, we've already started, obviously, down this path with the capital that we've raised that we're currently deploying. We are fundraising for additional capital for that vehicle. We expect to double the assets under management by beginning of next year, and looking to crowd in private capital as well. We'll continue to refine our structures, making sure that we're meeting the market where it's at with financing structures that can work with a wide range of companies. And really working towards deployment at scale, with deploying over $500 million by 2029. We're also scaling where we're operating, currently in Kenya, Nigeria, and Uganda, with a view to moving into additional markets in sub-Saharan Africa in the near term, specifically following where we see a lot of activity on the off-grid energy space. Next slide. And finally, we are fundraising for Nithya FI. We're looking to raise an additional 25 million by the beginning of next year. So we're trying to reach all pieces of the market. So are looking at a blended finance approach where we're seeking catalytic capital, equity, subordinated, as well as senior debt. We're an open-ended fund, so we're looking for investors across the entire capital stack and raising funding on a rolling basis from here on out. Thank you very much for listening, and look forward to your questions.
Thank you so much, Kate. I'm sure there are going to be many questions in the Q&A chat box, and I'll leave it to you and your team to try and answer those. But one thing that sort of strikes me is the credit risk assessment process that you highlighted. While you mention sort of all categories, is there a risk that it leads to exclusion of households that have a lower ability to pay, particularly if this capital stack is not structured right?
Absolutely, I think it's a risk. And this is something that Nithya is very, very conscious of, that I think as you look at alternative credit models, oftentimes the case is you're looking for only the top piece of the market. We're impact driven, and we actually, one of the reasons we were founded was to try and make sure that everyone is reached. So we think data is actually what drives that as well, that right now there's an inefficient deployment of public support, of this additional support that's needed to reach the last mile. If we can actually identify and categorize different types of customers, it makes it actually much easier to provide that philanthropic capital, that grant capital, public capital, whatever is needed to make sure you reach those households. That's why we think of it as the entire market, and there's the right form of capital for the right customer. But we shouldn't assume that everyone's going to be reached by a fully commercial solution.
Fair enough. Thank you so much, Kate. All the best. Over to you, Barbara, for the next one.
Thanks so much, Kate, and thanks, Vikram. Yes, so let's go directly into our second instrument from our Brazil program, which is the Guarantee Fund for Biogas that has been proposed by the Brazilian Biogas Association. And I'm very happy to introduce to you Felipe Bochevier, who is CPI analyst and who led the development of these instruments during a lab cycle. And he will tell us a little bit more about how to unlock finance for the biogas sector in Brazil. And then I'm very happy also to have here with us today Tamar Reutemann, who is the executive manager at Biogas, and who will be answering your questions on the Q&A tool as well. So Felipe, over to you.
Thank you, Barbara. I'll be presenting the Guarantee Fund for Biogas, the very first environmental-oriented guarantee fund in Brazil, which will provide short-term collateral for small and mid-sized biogas project loans. Well, Brazil is a large agro-industrial producer that has an enormous biogas potential, so much that 30% of the country's electricity demand and 70% of its diesel consumption could potentially be replaced by biogas produced from agricultural waste inputs. However, we still produce less than 2% of that potential. Currently, the Brazilian market has several commercial and subsidized credit lines that cater to biogas projects. But all these lines require some form of collateral, which often prevents smaller independent developers from accessing them, severely limiting the sector's growth. The Guarantee Fund for Biogas, or GFB, will overcome this barrier, this guarantee barrier. It leverages existing credit lines, unlocking new private and public capital. Other than being the first guarantee fund in Brazil with an environmental focus, it is also the first one to target the biogas sector. The sectorial focus will allow for a much more detailed risk assessment of individual projects, leading to a lower overall default. The fund will provide collateral for the construction phase of biogas projects, focusing on the most critical stage, when offtake agreements are usually not present yet. And here is how it works. The most important thing is that the GFB will be set up as a closed fixed income fund that will invest on Brazilian treasury bills, pledging its shares as collateral. These guarantees are registered as liens in B3, Brazil's main financial infrastructure company, acting as a public registry. This significantly reduces guarantee recovery risk for project lenders. Proponent at Biogas is the largest association of biogas developers, suppliers, and clients in Brazil, with over 80 associated companies. Their ability to mobilize different industry actors is instrumental in building and maintaining a sustainable project pipeline for the fund. They will also play a key role in the instrument, in the instrument structure as a certification agent that will validate technical, economic, and emissions parameters. The GFB can generate both significant social and environmental impact. Biogas itself is a renewable energy source that emits 96% less carbon than the Brazilian energy matrix average. while each megawatt delivered in biogas projects creates 2.28 direct jobs and 14 indirect jobs. In addition, the catalytic potential of the instrument is enormous. GFB can leverage significant capital and mitigate up to 135,000 tons of CO2 per year in the pilot phase, reaching 1.1 million tons at scale. This year, we are starting the fundraising and selection of a fund manager. In 2022, we'll proceed to register the fund. We expect the fund will be ready to launch within 1 year, supporting projects in 6 Brazilian states shown in dark blue in the map. I don't know if my internet is okay. For the pilot phase, we have developed an initial pipeline of 16 projects targeting agricultural waste, adding up to 29 megawatts of electricity capacity. This will require $53 million in capital, which should be split evenly between commercial and concessional investors. As capital is revolved back into the fund, the instrument has the potential of enabling $271 million in credit operations within 10 years. At scale, the instrument is expected to address 10% of Brazil's biogas potential and reduce yearly emissions by 7.8 million tons of CO2 equivalent. Beyond fostering biogas adoption, GFB not only delivers environmental results, but is also an opportunity for investors to kickstart Brazil's market for environmental guarantee funds. So with that, I will thank you very much, and we'll be ready to answer your questions.
Thank you so much, Felipe. Barbara's having some issues with connectivity, so I'm going to ask you a quick question, and hopefully she can come back in soon enough. Why develop a guarantee structure to enable small biogas developers, right? I mean, why not just leave the market for the larger ones? I mean, partly this is provocative, but they can bankroll the projects by themselves. Is there a reason to deploy concessional catalytic capital in this way? So it would be great to hear from you or Tamar.
Go ahead, Tamar, please.
Okay, thank you. Hi, Vikram. Thank you, everyone. So the idea is that these big companies, they already have balance sheets, and they can provide the guarantees. So the idea is for the small and medium companies, they have more trouble providing the guarantees that are necessary to the funding. So when getting the credit from the financing market. So that's why we are focusing on the small and medium-sized companies.
Great. All right. Well, thank you, and all the best for that. There are some questions likely in the chat or the Q&A section, so please do take a look there and respond as appropriate. And with that, we will move on to the last, but definitely not least instrument. We have the fourth one focused on Africa, and this is the instrument from the Sustainable City Stream, the ACT Fund. It is a pleasure for me to have welcome Tari Badagassin here, ARM Harit's Managing Director and CEO, to present their blended currency mechanism to attract climate investments for urban infrastructure projects in Africa. Welcome, Tari.
Thank you. Thank you so much for having me. Good morning, good afternoon, and good evening. I'm here today to present the ARM Harit Cities and Climate Transition Fund, the ACT Fund, and I'm joined by my colleague, Jobalo Oshikonlu, Director for Legal and Investments. ARM Harit is a joint venture between the largest non-bank financial institution in Nigeria and Harit, an established South African infrastructure fund manager. Both institutions have approximately $3 billion of assets under management. ARM Harit is licensed by the Nigerian Securities and Exchange Commission and the Financial Services Commission of Mauritius. ARM Harit has a strong track record for investments underpinned by robust ESG. Next slide, please. Managing capital from Nigerian pension funds and international investors, including the African Development Bank, our fund has raised capital from independent sources, operated the governance and legal architecture for a multi-fund vehicle, and has invested, or a multi-vehicle fund rather, and has invested and exited investments offering good quality returns to investors. Next slide. We take pride in the experience and diversity of our team at mid to senior levels, with balanced gender diversity on our board as well. Next slide. Next slide. So let's go to the problem. Africa's future is urban. 950 million additional people will live in African cities in the next 50 years, while the annual funding gap for infrastructure projects in Africa is $60 to $100 billion. At current growth levels, emissions could potentially double in African urban areas. Decisions made today on how urban infrastructure is built will shape the continent's carbon footprint for decades to come. The challenge is, how do we attract international and local investors in a sector and region where private financing is limited, costly, and time-consuming? Next slide. The solution. The ACT Fund seeks to attract investors to accelerate the delivery of sustainable infrastructure development and advance the climate infrastructure asset class for West Africa. Through a blended finance model, the fund increases the availability of equity and higher risk instruments in the capital structure by de-risking international equity investments via early exits and liquidity options, while also mobilizing domestic local currency capital through debt and debt-like instruments. Next slide. The fund operates in phases. In the first phase, hard currency equity and local currency sub-debt fund up to 65% of the project costs, with the balance coming from debt or sponsors' equity. This simplifies the number of additional parties required to take projects to financial close. At operations, the second phase, local currency senior debt is raised to refinance the equity such that a lower level of equity is left in the asset. Refinanced equity can be recycled back to the ACT Fund to achieve a higher multiplier effect on the number of deals financed. The balance of equity is then exited. Next slide. So our coverage areas, the ACT Fund will invest in West Africa with coverage verticals of renewable energy, mobility, waste, and water. Direct SDG impacts are SDG 7, 8, 11, and 13, with multiple indirect SDG impacts. Our pipeline at today consists of investments predominantly in the renewable energy sector, and we have a pipeline of up to $110 million, which we have been working on since we are an operating fund. However, projects in other sectors will be advanced prior and subsequent to fund closure, given some of the additional technical support that sponsors in the mobility, waste, and water segments need, and which we hope to address. Next slide. Our timelines involve commencing fundraising in Q4 2021 with a focus on technical assistance, equity, and then the local currency debt. Timing for fundraising completion is estimated to be 18 months. We estimate 3 years to deploy capital prior to the first set of liquidity events and 8 years of early liquidity and recycling for a fund horizon of 13 years. Our objective is to raise $250 million, a majority to be USD equity from DFIs and private capital, and a minority from local institutional investors. We are raising $10 million in grant funding for technical assistance for climate criteria, metrics measurement, and reporting. Grant funding is also needed for project development funding for developers in more nascent sectors like water and waste. Next slide. I would like to take this opportunity to give a special thanks to the lab, Ricardo, Cooper, Kyle, Ben, Vikram, Rob, Barbara, for all your incredible support. And to the attendees, thank you for listening to our presentation. We sincerely hope we can find a way to work with you. Now we're happy to take questions.
Thank you so much, Thari. I recall having a discussion with you in the super early days before you had probably even formulated this really well packaged proposition. Local currency and foreign currency remain challenging. You have sort of created another layer of complexity here. Perhaps you could speak to your experience with implementing, especially from a regulatory standpoint, multi-vehicle funds in 2 jurisdictions, right? I mean, so it would be great to hear from you on that.
Sure, I'd be happy for my colleague Jobalo to treat that. He's Director, Legal and Investments.
Great.
Jobalo.
All right, thank you very much. If you can hear me, this is Jobalo. Thank you, Terry, and thank you, Vikram. I think our experience on the regulatory side with managing multiple funds has been a successful one. We have a parallel fund registered in Nigeria and Mauritius. The Nigerian fund vehicle is regulated by the Securities and Exchange Commission in Nigeria, and the Mauritius fund vehicle is regulated by the Financial Services Commission in Mauritius. What we are finding is increasing cooperation amongst regulators, by the way. There's an IOSCO, an association, international organization for Association of Securities Commissions, IOSCO. The Nigerian SEC is actually a board member currently, and FS is also a member. Now we're finding that the principles around regulation are increasingly similar. There's the concept of risk-based regulation, risk-based supervision is getting more and more pervasive, and it's something we're seeing both in Nigeria and Mauritius. Now, what it has meant is that the requirements are similar where it comes to regulatory reporting, where it comes to corporate governance and other sort of requirements. We're also finding that the requirements are such that the regulators get more comfortable when they see that you have related parties that are also regulated and are not trying to be under the radar in the other jurisdiction. So it's working to our advantage. The fact that we are also regulated in another jurisdiction that is in the same association as so we're very familiar with Mauritius and Nigeria, for example, and even the other jurisdictions that you would typically consider to set up your parallel fund structures or your related fund structures are also embracing similar concepts and in the same association. So we're finding that it's one of the ways we have responded is that we also use the same in the representatives. For example, our Nigerian fund vehicle is a trust, is not an incorporated vehicle, but the Mauritius is an incorporated limited liability company, for example. But we have the manager entities that are all incorporated, and we use similar representatives, meaning that the regulators get more comfortable when they see that these are also representatives that have been screened in the other jurisdiction. So we're finding that it's not complex at all, and it actually streamlines our operations in various ways, having these multiple jurisdictions.
It is probably complex, but you have managed to address it, which is the good thing. So thank you both very much for this. And now over to Barbara to close us out.
Fantastic. Thank you so much. And thanks so much, Terry. I think it's fantastic to see really all the progress that has been made here. And yeah, looking forward to more here. Again, I think we are obviously at the end of our session here, but I do want to just take the time to thank you all for supporting this year's class of lab entrepreneurs. Each of the teams have provided their contact information, so we encourage you to reach out directly to them, and we also want you to kind of really reach out to us. I think after going through the lab process, all of our lab entrepreneurs are ready to hit the ground running to implement their ideas that you've seen today. So you can get additional information, including also additional contact for the team on our lab website. I think that the team is sharing that information in the chat right now. But I think it's the final message that I'd like to just share with you is that the lab is opening today. The 2022 call for ideas, it's extended until December. Information about the submission process is available on our website, and the link is on the screen here. So we are looking for a new cohort of innovative finance solutions that can unlock investment to tackle the climate emergency and present investment opportunities for a net zero economy. On November 16th, we will be hosting a webinar that will cover the 2022 call for ideas application process. So make sure you register for it. And again, we need all the ideas that you have in order to make sure that we can close the investment gap. And with that, I think I do want to thank you all for being with us today. Big thanks to Vikram for co-hosting with me. A huge thanks to all our entrepreneurs, and my team has put a lot of effort into not only this year's of the lab instruments, but in the lab more generally. So I do want to thank everyone for that. And with that, again, thanks, Vikram. And I think we are at the end.
Thanks, Barbara. It's been a pleasure. All the best to everybody. Thank you.
Fantastic. Thanks so much. So that's it for the Lab Demo Day. Make sure you follow the lab and subscribe to our newsletter to get the latest information on climate finance innovation. And thank you. And I hope to see you all very soon in person and next time at our webinars here. So thanks to every one of you.
Thank you.
Thank you.
Bye.
Thank you.